Greetings, listeners. I'm Bob Simpson, your host, and welcome to another educational episode of My Private Network. Today, our focus is on the concept Purpose Built Student Accommodation. Let's just jump right in today. My guest today, Aly Damji, is Managing Partner Real Estate for Forum Asset Management, and he joins us today from Toronto. You're in Toronto today, right, Aly? You've been moving around a fair bit over the last little while.
You got it. I am in Toronto.
Forum is an alternative asset manager, investor, and developer with a focus on real estate, private equity, and infrastructure, operating across North America. Now, Aly, based on your profile, I see that you've been involved in a lot of things, principal investments valued at up to $4 billion. That's probably higher than that today. You've arranged debt financing for more than $500 million. And you've secured over 300 leases, resulting in net operating income of over $40 million. So you've been busy. So, I'm a guy, I like numbers, right, Aly? We could go and just talk numbers all day, but, I know for the sake of our audience, most people aren't wired that way. So let's just give a little bit of flavor. Talk about Aly Damji and what drives you, what brought you to Forum.
Absolutely, Bob. So I bring a pretty unique background in that, I think a lot of real estate professionals, don't have a sole focus and a drive to wanting to be real estate professionals since they were kids. My mom has told me that, when I was 4 or 5 years old, when kids in my class were looking to be, NHL hockey players or police officers or firefighters, I've always wanted to be a real estate developer. So that's really driven me throughout my life, is to, be in real estate development and investment. And, just the concept of building and owning assets that people live in, work in, shop in, just resonates with me greatly. So that really drives everything I do and have been doing. In terms of my career background, it spans across all major asset classes. So I've been involved in all the major food groups. I've, cut my teeth in hotels when I started my career. I've been involved in office during office heyday, street front retail, large format retail, multifamily, student housing, industrial, and now even self-storage. And in addition to asset class focus, I've had the ability to work with a diverse group of investors. Prior to joining Forum, I worked for a private family and helped grow their real estate holdings. And I did that for 8 years, really acted as a fiduciary for that family. And then today, we manage capital for a diverse group of investors, both big and small, including, large scale institutions. And so, the perspective I bring to the table is not only just being an owner and investor, but also a manager of others' capital.
Yeah. So the first property you bought when you were 6 years old, you still hold it, or you just flipped it when you were 8?
Well, funny you mentioned that. I flipped my first property in my very early 20s and have done a number of them. So even in my personal life, real estate is a constant thing I am always thinking about.
Yeah, no, that's fun. So that's you. Talk about Forum for a bit. Talk about the work that your firm is doing for investors.
Absolutely. So we've been around for over 28 years. And over the course of that time, we've been primarily balance sheet investors. 3 years ago, we decided to embark on a journey to become a boutique mid-market asset manager focused on alternatives. We are driven by not only, returns. A core focus of our company, we have a tagline, is to deliver extraordinary outcomes. And that's not only for our investors or for our team, but also in the communities that we invest in. So impact is a big focus of ours. And we, measure this. We positively impacted close to 11,000 lives. And that's not by building real estate and saying, people have moved moved into our buildings, that's through philanthropy and charitable donations, which we, really focus on. Since embarking on our journey to become an asset manager, we've grown a development business that now totals over about $1.5 billion in completed value. That includes Purpose Built Student Accommodation. We've launched 2 real estate funds. We're about to launch a third fund, and our focus is really providing options to investors along the risk spectrum. So our flagship fund, which is focused on rental housing and impact, is, kind of core plus returns, 8 to 12% returns. We have recently launched a self-storage business and a self-storage fund through the acquisition of a self-storage manager, and that will be in the 12 to 15% net range. And then we also have a development vehicle where we bring in limited partners to help fund our developments alongside our sponsor equity, and that is, kind of 18 plus net returns. And the idea is to, ideally, together with our private equity business and infrastructure business, be a one-stop shop for allocators as they look to invest in alternative assets.
Yeah, so if anybody is listening to this and you have interest in any of the things that Aly's talked about, just give us a call and we can walk you through what your options are and how you can get involved in that. Now, Aly, trends are always important, right? Anybody who does investing, if they do it without having an eye on demographics, an eye on trends, eye on things like that, they're kind of wasting their time. They don't really see the big picture. When you look at trends, because you've been around and you played this since you were 6 years old, what are the trends that you're seeing in student accommodation in Canada today?
Well, it's a very topical issue, Bob, with all the headlines around students, particularly international students. What I would say is, we're driven in Canada by a number of things, including our demographic issue. We have, one of the lowest fertility rates in the world. Couple that with some really good things about Canada, which is our stable government, our world-class education institution, climate resiliency, and you have a number of people here who want to study in Canada as a gateway and entrance into permanent residency. Now, the problem with that is, as we all know, Canada has a pretty big housing issue right now. The lack of supply, affecting everyone across the country is pretty huge. We have the lowest vacancy rate ever. I think it was clocked at around 1.5% across the country recently by CMHC, which is the, federal government's housing agency. And CMHC has said as of last year, the number is actually higher now, that we need 3.5 million homes to restore affordability. So what we're seeing is that you've got this convergence of more people wanting to come into the country, particularly students, so they can gain, fast track entry as a permanent resident upon completing their studies, and you have nowhere to house them. And so what we are seeing is, strong rent growth, in student housing. And couple that with, the fact that student housing, I would say, is, a fairly nascent asset class in Canada. Markets such as the UK, US, and Europe, it's a very sophisticated asset class and has a lot of institutional capital behind it. Canada, we're, at the early stages of student housing accommodation, and that should create, tremendous value opportunities over time. Kind of finishing off on the trends in student housing, we have a 500,000 bed shortfall of student housing in Canada that's published by, one of the leaders in student housing research. And unfortunately, we only have 165,000 total student housing beds today and only 15,000 beds in a pipeline for development. So, we see the trend of strong demand, low supply, which, in turn results in higher rental rates continuing on for quite some time.
Yeah, it's also a good idea to be a leader when there is a new asset class, to be out there early. That's where opportunities generally arise. Is that what you find as well? Is that why you're excited about this asset class?
Very much so. I would say, there's a few things that make this asset class very interesting to us. Some of the characteristics I previously mentioned. We think it just drives a lot of alpha. So, on the other end of the housing spectrum, you take, for example, a number of established public or private REITs out there that are focused on multifamily. They're capped in their ability to achieve rent growth due to rent control and turnover. The average turnover, I'll give you an example, in the Greater Toronto area has historically been like low double digit, call it, 10 to 15%. And for the listeners, turnover refers to the percentage of units that vacate annually. Because of the rent growth in this country, because of the supply demand dynamics that I mentioned, this number has gone into the low single digits. And so the ability to capture rent growth has become very challenging for most of the owners out there who have, old stock. CapREIT, as an example, the largest publicly traded multifamily REIT out there, their average portfolio age is 40 years. And so, those buildings are primarily rent control versus newer buildings in Ontario, as an example, that are built, after November 2018. You can effectively mark to market every year and charge whatever, the market will bear. Student housing, we don't have that issue because students have natural turnover. They're, typically moving annually between units. What I would say and what we've seen is that if a student comes in from a first year dorm, second year, they're usually living in a shared unit, 2, 3, 4 bedrooms even. But then as they get older and mature, going to fourth year or even graduate years, they're moving to more private style units. Every time they move, that allows you to capture rent growth, even in a rent controlled building. And at a minimum, at a maximum, every 4 to 5 years, these tenants are moving out. Historically, in our portfolio, we've seen about 50 to 60% turnover, which is a huge difference compared to a traditional multifamily building. So that's really attractive because you're getting the mark to market on rents, you're capturing inflation, and those are some of the characteristics that, Purpose Built Student Accommodation offers compared to other forms of housing and even other forms of real estate.
At Private Debt and Equity, our website on which this podcast is listed, there's articles in the news recently about student housing, student accommodation, and that's where our newsletter got lit up. People coming in and saying, hey, I'm interested in student housing. There are a couple like student housing, music royalties, a few things that are off the charts for most people that kind of catch their interest. So for those people who come from that direction, they're thinking about investing in returns, and returns are not just about how much you make, but what kind of safety you have in that asset class. So talk a bit about, why student housing would be attractive investment option for potential investors.
Absolutely. So, like everything, Bob, the devil is in the details. And obviously, recently we've heard about a potential or actually an enacted cap by the federal government on international student visas. Now, what we've learned, because, the moment that information came out, we had our team do a deep dive on, where we believe this is going to be targeted. And in fact, more recently, there's been articles, explaining that a lot of the surge in international students has really come from private unregulated colleges and even public colleges. Some colleges in Ontario have seen, a 300% increase in the past 3 years in the amount of international students they've brought in. Our focus in student housing is to focus in the best in class university markets. We think these are stable markets, and much like investing in primary markets in real estate, which provides more liquidity, we feel the same way about, top university markets. And so, that's one differentiation that I would bring to the table. Not all student housing is the same. And that even exists for the type of units that one can acquire. So historically, we've seen competitors in this space own and develop product that have multiple beds. So, 5, 6, or 7 bedrooms. Our focus is on 4 bedrooms or less. We just see more demand for that product, particularly coming out of COVID, but notably CMHC, who provides government insured loans in the housing industry, they only insure loans on student housing that's off campus that has 4 bedrooms or less. So that's an important distinction because that creates more liquidity and values assets, on a much lower cap rate, because the difference between a CMHC loan today versus a conventional loan is about 150 to 250 basis points. You can take current CMHC loan in the 4% range and high 3% range versus, a traditional, a conventional mortgage, which would be in the 6% range today. And so that's another important distinction and one area we focus on. And it's characteristics like those you really want to make sure you're aligning yourself with, a group who understands all those important distinctions, because it can really impact your returns over time.
Yeah. So if you compare student housing as an asset class to other asset classes that are out there, how do they compare?
Well, I would go back, Bob, to what I mentioned earlier. The ability to market rents is really different in student housing compared to, say, for example, office or industrial, where you enter into long-term leases. I would say the only asset classes that turn over more than student housing are hotels and self-storage. Self-storage are on monthly leases. Hotels come with a lot of economic and cyclical risk in them. Student housing, we think, are bolstered by the sound fundamentals of the housing market, but have that benefit capturing frequent mark-to-market in rents.
Yeah. So one of the things that has affected many of the asset classes is financing. There are some, the multifamily groups who are in there trying to come in, upgrade it, bump the rents, flip it in 3 or 4 years. They've kind of been in short-term floating rate investments, and that's really squeezed their profitability. You're not in the buy and flip business, so you can better take a longer term view towards financing. What have you done? If you look at your portfolio, how does your financing line up?
Bob, so because we're developers and long-term owners, we have created a really prudent strategy in our development projects, which development projects are on similar, floating rate short-term debt. What we've done are things such as enter into rate caps or hedges during our construction term to minimize any interest rate fluctuation. Because what you probably heard out there and the readers have heard out there is over the past 2 to 3 years, as prime rate has increased, a lot of developers have run into trouble because all of a sudden, their loans are priced much higher than their interest reserves, which the banks would have provided them when they entered into construction loans would have, allowed for. And so that creates equity shortfalls. We take that risk away by paying slight premiums for caps and hedges during our construction duration. And that's a feature in all of our development projects, and investors can take comfort. If they ever invested in our development projects, that risk is mitigated. In our long-term assets, we benefit from what I mentioned earlier, CMHC insured fixed rate debt. In our open-ended fund, our flagship fund, which is focused on rental housing, our weighted average term to maturity is 7 years, and we have a fixed rate in the 3% range. So very attractive. And, I think that provides a lot of certainty for investors that, returns won't fluctuate because of that weighted average term to maturity. Again, because we focus on student housing that has 4 or less bedrooms, as well as traditional multifamily, we can benefit from that low-cost CMHC insured mortgage product that is the lowest cost financing out there in the real estate industry.
Yeah, one of the things that I had fights with my kids about was, they have some pretty big mortgages, and when rates were down near zero, I said, lock it in, lock it in. And they said, no, but you got to pay too much to lock it in, right? Now they're finding out how much they have to pay to not lock it in. Back last summer, I attended a tour that your firm did at York University. Yeah, and I just have to make a comment that, you're talking best in class, but I haven't seen in your portfolio that you have student residences yet at Western, which would be best of class, right? You have York and that sort of thing. Is that, but that's where you went, right? You're a York grad, I saw in your bio.
I am, yes.
Yeah. But I did a tour of that, of the quad at York University. It's spectacular. What I see is that the average property is about 4 years old. Pretty new, huh?
Yeah, our portfolio, really compares favorably to some of our competitors, both in the private REIT space and public REITs. Public REITs, we did some research and found that the average age of the publics is about 40 years in the multifamily focused REITs, compared to ours at 4 years of age. Even on the private REIT space, the average age is, much higher than ours, 10 to 20 years, depending on the REIT. And what that just means is that these owners and operators need to, reserve more capital for capital expenditures and repairs and maintenance. And that's a distinction that we have a huge competitive advantage over because of our new age assets, many of which are built from our development pipeline. We don't have to reserve as much income, and it can flow to the bottom line to investors and pay higher distributions. So that's a key distinction. Going back to our development business, I think that's a unique offering we bring to the table compared to the public and private REITs. As I mentioned earlier, we are developers. We have $1.5 billion pipeline of various housing developments, and our open-ended flagship fund has a right of first opportunity to acquire all those assets. That means the portfolio will, as some of our existing assets get older, they will be replenished with newer assets. And we think our average age will, continue to be among the best out of the competitive set. And it provides investors and our fund another advantage is that we don't need to compete in the open market to acquire new age assets. New assets are what institutions and some of the public REITs are coveting right now. A number of the public REITs are trying to recycle capital and sell all their old product and add new product to benefit from, no rent control or higher turnover. And these assets get really bid up in the marketplace. Having access to a development pipeline, ensures we can just grow organically through, forums, own activities.
Yeah, and I guess if there was an opportunity down the road where, let's say, your inflow of funds coming in slowed down, you could take one of your older buildings, just flip it out and build a new one. And that probably helps your portfolio. Is that something you'd look at, or are you pretty much buy and hold forever?
No, we're prudent managers. We're always looking at portfolio construction, and we're definitely focused on long-term growth and value, and most definitely our portfolio will continue to grow over time. However, we're always looking at assets, that we think if they've been optimized, or there are market changes that are coming, and because we're have deep market knowledge, we can see these things well in advance. We'll look to recycle out of some assets over time, but that won't be a constant activity of our fund, our open-ended fund, because our goal is to grow it and grow income over time.
Yeah, talk a bit about, while you're talking about age of a product there, the quad, just talk about it, where you are in that. I was just totally impressed with the building, but when I was there, I think you're just breaking ground on the next unit next door. Just talk about where that property sits.
Absolutely. So the quad at York University stems back from an RFP that we won back in 2010. And it was the ability to build private on-campus student housing on the Keele campus of York University. Our first phase started construction in 2015 and was completed in 2017. That delivered about 800 beds. Then in 2020, we started construction on our phase 2 building, which ended up completing in 2022. That added another 700 beds for a total of 1,500 beds. Both those assets are now owned by our open-ended fund vehicle, and we consider them the preeminent student housing assets in the country, given the fact that they're located on campus. And now York University has a subway line, which Western doesn't have, by the way. Must get that in there. And then right now we are embarking on the next phase of the quad, and we plan to start construction at the end of 2024 on phase 3, which will deliver another 800 beds. And shortly after that project is constructed, we think in time for the September 2026 school year, if all things work out, we will then quickly move to quad phase 4. And so in total, we think we'll have about 3,000 beds once all 4 phases are done. And York University really needs a lot more housing. In our latest estimates, they require 12,000 student housing beds. They have a pretty old stock of housing themselves that they will need to renew. And so, the need and urgency to deliver more student housing on campus at York is great.
Yeah, so touch on ESG. Everybody's interested in the environment today and should be. We've just had a winter in Toronto with no snow and temperatures. I think it's cold today, but it's going to be back up to 14 degrees or something in the end of February, early March. How does your firm look at ESG and how socially responsible are you taking things when you are building or running a building like this?
Well, before we go into that, as an avid skier, this season has not been great. So, El Nino has certainly, rained all and washed out all the ski hills in Ontario. While this year, largely the weather patterns were due to El Nino, we do know, and as you noted, Bob, we need to take climate change seriously. There's an issue globally. The world is getting warmer. It's causing impacts around the globe. We have a really pragmatic approach to how we drive impact in ESG in our portfolio. Put simply, we think that being environmentally sustainable and socially responsible in our investment activities delivers alpha and higher returns. I'll give a good example. In our open-ended fund, we embarked on a strategy of making sure we install water-saving meters throughout our portfolio assets in buildings that did not already have them. So that's a really emerging technology. Over the past 12 months, we've saved hundreds of thousands of dollars in utility costs through our water saving meters, as well as other initiatives that we put through our portfolio, such as building automation systems, which help bring temperatures up and down, occupancy sensors, so that when you're walking through a building, lights turn on as opposed to being kept on all the time. When you're saving that amount of money, that ultimately drives higher income and higher asset values. Our focus is not to create impact in ESG just to make ourselves feel better or for marketing purposes. It's truly pragmatic and returns driven. And we believe over time, buildings that are more sustainable will have greater asset value.
Mm-hmm. Yeah, I would agree with that. Yeah, sort of final point, Aly, is the importance of alignment with investors. And having Forum as the largest investor in the fund that we're discussing here today. Just talk about that for a sec.
Yeah, we think alignment is so important. It really drives everything we do in all of our investment activities where we have outside third-party investors. I'll give a really good example. So in our open-ended flagship fund, we are currently the largest investor, and we plan to be over time with a minimum $50 million commitment at all times. Some of your listeners have probably heard about valuations and disparity between what asset managers are holding asset values in their funds versus what's actually happening out there in the open market. And some of these managers, they're doing this because they're misaligned. If they drop their asset values, their fees will drop and their promote and their incentive fees will be reduced. For us, because we're a major investor in the fund, yes, we earn fees, but more important than the fees are the returns we generate from our investment holdings. And because of the alignment we have with other investors, we are always, erring on the side of caution when we're looking at our asset values. A really good example is this past year in 2023, we delivered about an 11% net return for our Series F return share class. That was done because we were able to capture a lot of rent growth, but we also marked up cap rates by 30 basis points. Had we not, we would have had a return closer to 20%, which would have driven much higher promote and much higher fees. But as a prudent investor, we decided to ensure the portfolio represented the reality of what's going on out there. So it's an important point that you mentioned, and one that should not go unnoticed as your listeners are looking to make investments in funds with managers.
Yeah, it's always important to work with managers who are prudent and are working in the best long-term interests of investors. And, I think depending on when this particular episode gets released, we've just done an episode on liquidity and why firms like yours are really looking for longer-term investors. We're not looking for those who are trying to flip it and say, oh, I think if they don't raise the cap rates, we might be able to pick up a few extra percent this year and then we can get the heck out and move on. You're really looking for that longer-term investor who's making a decision that this is a good asset class. They want to put it away, just let it grow. Is that a fair statement?
Absolutely. Our open-ended flagship fund is, we look to as a permanent capital vehicle, and we're really looking for sticky investors who believe in the long-term story of the Canadian rental housing sector because of the supply-demand imbalances that we talked about, because the fact that our government needs to continue to let in people given our demographic issues, and, the fact that you've got this tremendous imbalance that won't be resolved for many years.
Yeah. So Aly, thanks for taking time to join us today and help investors better understand that there are some interesting ways to generate passive income in real estate.
Bob, really appreciate the time. Thank you for having me. And I hope this session has been informative to your listeners.
People who invest in your fund don't get calls in the middle of the night that a toilet's plugged or anything, right? Is that, I was asked to ask that
absolutely not.
Let's not do that, right?
No, absolutely. Yeah.
From a disclaimer point of view, before making any investments, it's crucial to consult a professional financial advisor to determine suitability. We have full disclaimers available on privatedebtandequity.ca. Also, don't forget to follow us on your preferred podcast platform, subscribe to our YouTube channel to stay updated on new episodes. If you're eager to learn more about today's topic, look at the dedicated channels within privatedebtandequity.ca, and you can learn and improve your education about investing in today's private debt and equity opportunities. So just in closing, I'm Bob Simpson. It's been a pleasure to guide you through this enlightening conversation. Aly, thanks for coming out, spending the time. I know you're a busy guy, but please remember, knowledge empowers you to make informed decisions with your investments. Until we meet again, stay focused and disciplined on your financial journey. Thanks for listening.